Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:31 a.m. Central Time, and I'm recording this in preparation for the market day of August the 14th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in, see what we had in the overnight. A little bit of weakness across all four of the broad market indices, and all about the same, about 0.25% off. And not enough difference between the four to really comment on. Crude oil also down about 0.25% at the time of this cut. Euro up about 1/3%. Bonds up about 0.5%, and gold up about 1/3%. And overseas action a little quieter than has been the case in some recent days. China up about 0.25%. Hong Kong down just fractionally. Japan down about 1/3%. Germany down about 0.5%, and United Kingdom down just fractionally. In terms of macroeconomic reports for today in the United States, we have the utilization rate, industrial production, and also the University of Michigan Consumer Sentiment reports. So be aware of those, especially the ones that happen during trading hours. In terms of volatility, let's see, skew backed off a little bit, so that potential warning sign has ebbed at this moment. Short-term VIX also backed off a little bit, 13.63. You see the IV percentiles all very low, 21, 34, 30, and 36. Nothing really of note there. We had that little burst of price volatility there for several days with the standard deviation moves, but those have now aged off a couple days. Though it's a little misleading at this day right here, day 2, obviously had a huge intraday reversal, lots of price movement just to end up pretty much back where it started from, and less than a standard deviation move for the day. In terms of our regular daily report, not a lot of changes here. Let me bring up one thing I got here from Shadow Trader this morning. I thought this was kind of interesting. They have their indicator they call money flow, which takes a look at the broad market money flow and how that differs from the price action. And the point here is larger money flow declines were seen Tuesday and yesterday, which pushed the measure significantly than the last time they posted on 8/7. Market tops are made of choppy price action resulting from repeated cycle where short positions are squeezed and then reasserted until finally a breakdown occurs. Money flow gives us more confidence that this is exactly what is taking place in the U.S. broad market indices. So bottom line is that the institutions, and they're the ones that control the bulk of the buying, are not actually buying back in any kind of volume, and this continues to just kind of fall off. And you see this money flow indicator breaking the trend while price continues to kind of appear to be holding the trend, but the participation, and then we see this, we've been talking about breadth and the advanced decline as well, and the same kind of thing, but just a point of weakness there I thought I would mention. And indeed, as we look at our own assessment of hedge risk and these kinds of things, we continue to see significant signs of weakness. IBD is basically 3 weeks now uptrend under pressure, and very poor accumulation distribution curves. Those charts are now scored at D+ for both the S&P and the NASDAQ. GMI, interesting enough, continues to be a 6 out of 6, but I believe the author of that is in all cash, as this thing has been flipping back and forth, so not a sign of confidence in the market there. Stock charts, decision point, lots of red down arrows, so there's a measure there. And our intermediate term market posture, very bearish, and position sizing opinions also remain the same. Long side exposure up to 50%, so a reduced position size, though the active trader posture, the VIX, is still within that 12 to 18 window, so that still calls for a regular position size. You see this market posture, and we call it very bearish. It's dropped below 50 on the S&P. We're also below 50 on the NASDAQ, as is the Dow, but the Russell is actually severely bullish, severely bearish, I should say, and below the 20 area. Hedge warning status remains at level 1. Yellow lights or hit that break, and there's many reasons for that, some of which we've already discussed. From a volatility standpoint, we still have warnings coming in, market in decline and sharp increase warning. We still have this VIX daily squeeze, which portends an increase in volatility. Still have a very high distribution day count, though it has not changed from the prior day. It's sitting at 8 on the S&P. You have all 5 conversion indicators flagging as risk off, and no change from yesterday in terms of the special opinions. VIX is inside the acceptable window, so for option income strategies it is okay, but certainly you got to consider the increased potential for volatility given that daily squeeze. Covered calls, really probably pretty poor conditions for both covered calls and put selling. Been doing a little bit of put selling, but certainly following this opinion of reduced position size or scaling into positions. Some things to kind of consider there. In terms of sector specific, mostly red here, with the exceptions being utilities, being the lone sector that across all 3 time frames was kind of holding up. And in this analysis, on a sector percent change, only financials and consumer discretionary were positive yesterday. You see utilities actually was essentially flat. So, and it goes down from there. Look at energy. Energy, we commented yesterday that energy was actually starting to show some consistency in being able to hold this neutral status in the lower time frames, but it still is quick to give up, and when it does give up something, it seems to give it up in large dollops. So that's a very difficult sector to be long in still, it would seem. So I think that's probably enough for today. A little shorter video today, not a lot of change from the prior day. We continue to see elevated levels of risk, but yet at the same time not levels of risk that would call into question that we are in a full out breakdown mode. And let's put this back on daily. We're frankly right in the middle of the range and right in the middle of this coiling pattern or triangle until we get a breakout and a confirmed breakout. Obviously we had the whipsaw false breakout here, but a confirmed breakout from the coiling pattern, you really have no indication of even a short-term trend. And until you get outside of this larger trading range, we still maintain you really have accomplished nothing in terms of the longer term trend. So no change there, and that's just kind of where we sit. If you find what you're getting from here helpful, we always appreciate you retweeting us to your Twitter followers or your StockTwit followers, liking us on your YouTube channel or subscribing to the YouTube channel. All these kinds of things are very, very helpful. We notice every one of these that comes in each day. Feedback can be sent to support@falconglobaltraders.com, as well as comments. Comments can go there as well. Additional information about what we do and how we put all this into practice can be found at this website. And disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And we'll see you back Monday morning for the market preview from Falcon Global. Good trading.